This is Forensic Forex with Deontay, and I'm back with another video. This is episode 14 to the Asian Session Library. Once again, back here with UJ. There were other examples, but I'm just going to go to the most recent one we have in present day, which is October 26th, Thursday, which was yesterday. And we're going to walk through all the steps. There are ample examples on this model. If you just go back to episode 1 and work your way back up to now, episode 14, you'll see every single time the model is the same, nothing changes. So for those that are new or just first time watching this video on the model, what you're doing is looking for a purge and revert or a turtle soup setup. How we find this is by taking the 12 p.m. to 8 p.m. session, which is the New York lunch session. And I call it the lunch session because it's after New York. Everything goes on lunch. And during this time period, it has a characteristic of consolidating. Price is most likely going to move sideways. If you look at any FX market during this time period, you're most likely going to be faced with consolidation. With that consolidation, we then find the 15-minute swing highs that are left unbroken and the 15-minute swing lows that are left unbroken as well. There's buy side liquidity above this high and sell side liquidity below this low. There are other ones that I didn't mark off, but I just marked these off here briefly. And as you can see, these ones are not broken. All these ones are not broken. There's even one right here as well. Here, the highest high of the session. I also like to mark that off. You can see this swing low is the lowest low of the session. We're going to use this as an opportunity to find a purge, then revert. So we're trying to catch a turtle soup. So it doesn't matter which direction it goes in. We're just going to see if it gives us a signal or a fingerprint to go and take that trade. So if we play it forward, you can see that's the Asian session open here. So we got premium versus discount. That is an ideology that will help you understand which side of the market you should be most likely playing. Should you be a seller or buyer while being above 8 p.m. opening price? In my personal experience, I think you should be a seller because price is higher than the open. It's more expensive. It's overbought. Same thing vice versa. Once price drops below here, I would like to consider myself a buyer. As of right now, we can see we run up and take out the 15-minute swing high here and here. At this point, we've rated buy side liquidity. There's a purge on buy side. This model is trying to catch a revert or a turtle soup, a false break, back down to sell side liquidity since it started going up first. So at this point, I like to go on the 1 minute and find a market shift above Asian Open's price. Let's just zoom out. That's the opening price. We're looking for a market shift after price takes out these 15-minute swing highs. So we got one here and one here. We're going to play it forward to see if we can find any. So we play it forward candle by candle. No market shift yet. There we go. So we have a market shift right there. And many people ask me, what is a market shift? In my definition, this is what I believe a market shift is. When you're seeing displacement to the downside, so speed, there's a fair value gap that runs to a swing low. So here's the fair value gap. This candle's low to this candle's high. That's your fair value gap. And then here comes your swing low. Why is this a swing low? Because the candle here in the middle has a higher low here. And the candle on the right has a higher low here. So this makes this the lowest point. That makes that swing low. The fact that price runs that swing low with speed is indication that market makers most likely want price to go lower, or the algorithm is pricing in to get lower. You can see this PD array itself forms above the Asian opening price, this dashed line here. That's the open. So we're still in a premium when this market shift occurred. We do have a fair value up here, right? Which could be traded into, but ideally we like to take this one here, the market shift. We used to like to take the first fair value gap that formed. However, I believe that the market shift that forms first after taking out the buy side or vice versa, the sell side, it's going to be the ideal possible area for a opportunity. So here we would go short. How would we do that? We simply go short at the bottom of that candle here. Where would we place our stop loss? Now, it all depends on how much risk you're taking. But if you had to place a very tight stop, it's most likely going to be above the high or most recent swing high just after the fair value gap is formed. So this candle itself is what starts the fair value gap and is also swing high. So you could be placing your stop loss just above that candle. Or you could take this swing high as well, once it's within the means of how much you're going to risk. At that point, you're going to be looking for at least a 1-to-1 ratio or doubling what you're trying to risk. Most people want to risk $1 to gain $1. Some people want to risk $1 to gain $2, gain $3. That's how it most likely works. So here we would say, let's say this is the ideal setup we're trying to get, or ideally we're trying to grab 20. Let's say we're trying to grab 20 pips out the market. And you can see 20 pips is definitely reasonable because it's within the means of what? These 15-minute swing lows as a target. Now, a 20 pip move, it's a very feasible price point. You can grab 20 pips out of a session's range. There are times where the Asian session is less than 20 pips, but generally, if you were to look at the average of Asian sessions, they definitely are at times above 20 pips. So there's a possibility that we could rule in that we could gain 20 pips during this session. So we're waiting for price to trade back up into this fair value gap and then give us a short opportunity to the 15-minute swing lows. So we're trying to catch a false break. Catch retail traders doing what? Chasing price on the breakout. But we're looking to short that. We're using them as counterparty to our shorts. They're going long, but we're using their longs to cover our shorts. So that's what we're doing here. So if you play price forward, it's a little too fast. You see we trade up into it. Remember, we defined our risk. Like I said, we always got to define the risk before we take in the trade. You see that first 15-minute swing low is taken right there. And we're still threading back and forth. But at that point of that 15-minute swing low getting rated from where we went short, let's say right here, that's let's say we round 8 pips. That's a great quick way to get some points out of the market. 8 pips, take that, pay yourself. 10 pips, pay yourself. 20 pips, pay yourself. That's a great time to take off something. And we can see it's definitely a target. This is a projection lower, right? We're aiming for this as a target because we rated buy side. We're running back to sell side. It's that simple. We don't overthink this process. Now, yes, there may be other PD arrays that you could be looking at besides this one that I'm talking about here. But this is the most one I'm familiar with and the ones my eyes like to locate all the time. I can't unsee it. That's why I'm showing this series, showing the same market entry over and over and over again. It doesn't change. The entry has never changed. And you play it forward, speed it up for the video sake. And slowly we find ourselves working our way down, gaining 20 pips. Got 20 pips right there. So we measure that out. 20 pips. And we can also see at times, it doesn't just give 20 pips. It could continue to go on. Let's say you had a trailing stop. And many people always wonder, how can I trail my stop without getting stopped out? That's the risk you take. There's going to be points where price does run up and clean out swing highs. Instead of these swing highs, for example, let's say you went short and you want to move your stop loss above this high here, move this stop loss down to this high. Who's to say that when price went here, it couldn't have ran up a little more? It could have. That's a possibility. And you would be stopped out and then it would have left you. So sometimes it can be difficult and those are things you have to live with. But however, we saw UJ sell off today on Friday, huge sell off, and we can see how it carried on into today, Friday's close. So if we go back on the 15-minute time frame, just to speed this up, you can see there's another example here, but we're going to talk about that in another episode. You play it forward, we're in a dead zone here. Any gray points are dead zones. Any colorful points are live zones. So Asian lunch, London session, London lunch, New York session. We have London close. There's a space here. Should be shaded orange, but not that important to note off. And then we go back into New York lunch, which is the same area here that we most likely find consolidation. And you can see this was the high for Friday. Price continue. If you look at the Friday daily candle, this is where it started from and continue to trend lower today. So just as a reference, just to be transparent, go on the daily. That was that huge sell-off today for UJ. Price going up and coming down. But overall, that's the Asian session model. That's what I'm looking for. I'm just simply looking for an opportunity to go short or long after retail traders have convinced themselves on the breakout. They've convinced themselves on the breakout above these highs. I say no, I'm going short because I found a market shift on the lower time frame to find an opportunity to go short here. Fair value gap with speed down through a swing low. That's where I'm looking to go short. Now, of course, you can pyramid these, and if you find another market shift along the way down, you could take the risk to go in short. Remember, you are taking the risk on trying to go short in a discount. Ideally, you want to be getting your best bulk position above the opening price or near the opening price. Sometimes you may not be able to get that premium sell because these opportunities happen very quick. Some tips and advice when it comes to this session, normally I like to see by 9:30 my trading is already done. I've already completed at least 10, 15, or 20 pips before 9:30. That's very ideal. I know that's when the setup is successful and there's potential opportunity for it to be trailed lower or trailed higher, and I can squeeze a little more out of the market. At times where price is stalling and we get to 9 o'clock, 9:30 still, and I'm still sitting up here and not getting that dynamic move away from my entry, most likely the setup is going to fail. That's what I've been noticing. Like I said, do your own due diligence, back test, look at what you see in the market, because it may not be this PD array here. You may be looking at a different PD array. You may be looking at an order block. You may be looking at a volume imbalance, maybe a gap, maybe a mitigation, a breaker, something else. But this is what I'm looking at here. And if you follow it step by step, you'll be able to see which Asian sessions this month were successful. So that's something I'm going to do. I'm going to leave a link to a Google Docs that shows all the current Asian sessions and their results to current day. Hopefully this is insightful. Peace.